Hello and welcome to LiveSquawk's preview show. My name is Harry, managing editor at LiveSquawk News. For anyone new to who we are, we're an audio news service, financial market news service. We aggregate headlines and social media posts and alert you over our web browser player to anything that's important and potentially market moving. We cover geopolitics and financial market data points from the G7 and the wider G20 where it matters. And we're bringing you our, what I call them podcasts, just little briefings, really, preview shows ahead of key data points. For today, Wednesday, we're looking at the inflation report, the US January CPI report that's due out today at 8:30 Eastern Time, 13:30 GMT. And I'll be joined by a couple of guests to come at it from different angles. We have one of our guys who's a portfolio manager and works at Arb Asset Management, Sam Cutler. So we'll be joined by him, and I'll give you his full title in a minute. And by prominent crypto trader, Trader Boy Carty. So what we will do now is, before we start that, go try us out at www.livesquawk.com. See if it's something that may help your trading day. Excuse my voice. I've had a cold of late or something, man flu. Call it man flu of late. So please excuse the voice. Also, I have to give you a quick disclaimer before we go any further. The content provided on this channel is for informational and educational purposes only. I'm not a licensed financial advisor. None of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of any future results. LiveSquawk, or none of my guests, are responsible for any losses or gains that may result from the following content on this channel. And with that, just a formal introduction to my two guests. I'd like to introduce Arb Asset Management and Portfolio Manager of 333 Capital, Sam Cutler, to the show. Hi, Sam. You've been on before, so welcome again.
Thanks, Harry. Appreciate it.
Excellent. And as I said, prominent crypto trader, Trader Boy Carty. How are you doing?
Good, and yourself?
Awesome. Right, just to give our audience a quick heads up as to what we're looking at today. As I said, it's the preview for the US inflation report that's due up today, as I said, at 8:30 Eastern Time. Just to give you some of the consensus here as well, the forecast. So again, the key, most people look at the year over year, but so we'll start there. The year over year headline expected to stay on hold at 2.9% for January. On the month over month, we're looking at a small reduction of 1/10 to 0.3 from 0.4. On the core measure, which is the ex-food and energy component of the report, year over year, we're looking at 3.1%. That's also looking to drop slightly from 3.2. And the ex-food month over month seen at 0.3 versus 0.2. A note here from Citi on today's number. They posited that there will be a heightened focus on the January CPI data. They expect an unrounded 0.34% month over month core CPI reading, which will translate into 0.31% on the month over month core PCE. That's above target on a monthly annualized basis, but coming in below last year's reading would mean that year on year core PCE will begin falling from its December 2.8% year over year reading. Softer inflation readings in February and beyond should drive the message that inflation is running close to target by the May FOMC meeting. The single most important driver of our projections is the slowdown in shelter prices that we expect to be sustained. I've written a piece that's up on our website, so please go and have a view of that. It's open to the public at the moment, so not just members. But it's worth noting, as well as the headline numbers, we will get January's estimates will be accompanied by revisions to prior seasonal adjustment factors. Analysts have suggested that any seasonal strength should be concentrated in core services prices. So we'll have a look at today's number. We'll also look at potential Trump tariffs and the Trump tariffs already executed, and see what that may well do to both the economy and the markets. And we'll also, again, as I said, look from a crypto perspective on what to expect, or what we can see from, or how it will affect the crypto market. So with that, I'd like to bring in Sam first of all. Sam, hi. What do you see from today's number that excites you?
Okay, yeah. So I mean, I guess I want to back this up a little bit and talk a little bit, kind of leading into this with Trump, right? Because Trump has made a lot of promises to lower inflation for U.S. consumers, right? He kind of harpened, the Biden administration on some of their policies and how they were very inflationary. So that's been a big point for him. And if we look at kind of the hard data and the soft data, right? So you got a lot of these surveys coming in. Last Friday, one that stood out is those 1-year inflation expectations from the University of Michigan, right? Now, these surveys to me are becoming very hard to take at face value because they're seeming to be very highly politicized, right? You can see the discrepancy here between inflation expectations by party, right? So you look at the Democrats, right? They see inflation severely picking up under the Trump administration, while the Republicans see, inflation pretty much catering here. Yeah, quite the opposite. So I think, these things are becoming highly politicized. So it's very hard to take them at face value. So for me, I start to kind of look at kind of inflation markets, right? So we tend to look at the swap markets, and these markets do seem a little less sure, right? Swap traders have kind of gradually been pushing up their inflation expectations over the past couple of weeks, which does suggest that there is concern about some of these economic ramifications of tariffs, right? And I was kind of looking on Monday when Trump announced these fresh levies on steel and aluminum. There wasn't a huge reaction in swap pricing here. And I'm starting to wonder if that's because how quickly, and I say this in kind of air quotes, the Canada and Mexico tariff war was resolved, right?
You're talking from a credibility perspective.
Exactly. Yeah, I think that might have dampened the credibility on how serious the market is going to look at these tariffs, because they were very quick to dismiss the first round, right? There was a big market reaction. It was resolved within 24 hours, and I mean, you just saw massive mean reversion. I mean, if you look at the Canadian dollar, right, on that announcement, it spiked up to $1.48, right? And immediately within the day was back down at the 144 handle, now sitting a touch under 143. So I think they lost a little bit of credibility in that with the markets. And I do think that is going to ultimately be a mistake in the markets, right? Because if we do look at...
But just to clarify, you see the markets, this is a mistake for the markets or for Trump in terms of what he's trying, the effectiveness of what he wants to try and achieve?
I think it's a mistake for the markets to quickly dismiss these things as quickly as they are right now. I think this could definitely be something much more important as we move down the future. And I think we'll see that, in a little less than 30 days when these tariffs are again supposed to come into the play, or they go into the negotiation table. But wanted to touch on the other survey, right? Because we did get the Cleveland Fed's January survey from the business leaders, right? And that's showing inflation, pretty solid, right? It's expected to be at 3.2 in the next 12 months, which is down from 3.8% in October. Just the other day, we got the New York Fed survey, which showed 1-year inflation expectations holding steady at 3%. And if we kind of blend that into a part of Powell's testimony yesterday, he doesn't really seem too concerned about Trump policies and inflation.
Okay, you say it doesn't seem he can't. He's in a rock and a hard place, I guess. He's talking to politicians on Capitol Hill. He has to stay neutral. He has to remain, on the fence in terms of his views. He can only look at it from a monetary policy perspective. So maybe wasn't that surprise? Is that a little bit of surprise? He didn't. Well, not a surprise. He didn't take the bait in terms of any sort of.
Yeah, I think that was kind of widely expected for him to really try to avoid any type of tariff conversation in that testimony. I mean, a couple of them did push to try to get it, and he really did, the typical Powell lawyer maneuvers that we see in the press conference of kind of avoiding the question and kind of reframing it in a different matter.
Yeah, he's done well. So sorry, just before we carry on, I just want to bring in Trade Boy Carty on this. As a crypto trader, how do you, first of all, how much do you pay attention to today's CPI report, and more importantly, we know the benefits of Trump, the new Trump administration to crypto and what the crypto market thinks of Trump. He's pro crypto, we know that. He's got Elon Musk on board and others. But in a day-to-day trading environment, we'll bring it back to the inflation picture in a minute, but more generally on the Trump situation, how do you position yourself for Trump at the moment and the comments that he comes out with?
So thank you very much. I'm just going to preface really quick before we continue. I do trade for Credo V, so it's one of the subsidiaries of RPTG. I'm on the prop desk there. In the current environment, at least I could say since COVID, at least I've been in crypto since 2016, but since COVID, the crypto landscape has been pretty much dictated by the moves of the S&P, CPI, FOMC, NFP. These were the three big ones that actually had edge in, say, 2020, 2021, where you could trade them. And I believe that coincided with FTX, how they were running a spread algo. But since then, it's become a crowded trade. And ever since Bitcoin became more of a, if you want to say, a mainstream traded asset, starting with the ETFs and also the CME and whatnot, and a bit more volume coming in on the institutional side. I consider it more so now just a leveraged version of the S&P. You could call it the BTC 500, just as a joke.
Interesting.
Yeah, and then so you'd see, say, if the CPI comes in hot, you're going to see a move, and let's say, I don't know, S&P takes a hit 0.5%, Bitcoin could fall 2%. So the correlation to the downside in at least in this environment right now, I'd say is more perfectly correlated than opposed to, say, the upside of the S&P. Crypto being like, the most tail risk you would put into a portfolio at the moment. Say if it's a risk-off environment, people will look to cut that before they say, look to cut their other positions. I mean, I don't think many people on planet Earth, at least in the wealth management space, we could say, are selling Apple to buy Bitcoin, right, in their retirement portfolio. So it's become more of a institutionalized asset over time. But I still believe it is the most pure market that exists in trading, seeing as it's not as big as the other traditional markets, and as such, there's not as much money, and you could say like the big money algos really haven't taken over as much as, say, the S&P or other commodities and stuff like that. So we'll see what happens today. The crypto space has been kind of muted, actually, since the inauguration, just because everybody was, once Trump won the election, we had that crazy run up to 100K, and we're now hovering just below it. But traders expected the strategic Bitcoin reserve, so they were buying into that. Buy the news, sell the rumor. It still hasn't happened, the strategic Bitcoin reserve. Whether it happens or not, and whether you're a proponent of it or not, that's up to you. But with that being said, crypto at the moment, as of now, is just going to see a bid when the world has a more risk-on environment, and I think that's completely correlated to the 10-year. So at the moment, at least. So we'll see what happens today with the CPI. But should it come in hot, you should see a pretty good dump on crypto and I guess the S&P. But they usually retrace unless it's like a crazy hot number. But if it's just within expectations or slightly over, you would see a dump, and then they usually retrace by the open, and Bitcoin would do that same thing. And then after that, you would see what the market determines for the day.
Interesting. That's good perspective. Thank you for that. I wanted, talking about other markets and commodities. Sam, you've got a gold chart up here as well, and we've seen gold outperform. Would you say outperform of late? We're hitting record highs every other day, it would seem, at the moment, and it sort of maybe goes back to what Trade Boy Carty is saying about these smaller markets, and less liquidity in some senses, and just seeing the movement that we're seeing, the exaggerated movement that we're seeing at the moment. What's your take on the gold?
Yeah, well, I mean, yeah, of course, gold is outperforming. I mean, gold is up, year to date, 983 bips versus, the S&P, which is up 318 bips, and the NASDAQ underperforming the indices at 172 bips.
So a little bit of outperformance.
Yeah, a ton of outperformance here. And I think, that kind of feeds into the market showing, very similar to how those inflation swaps are rising, that, gold being known as a very classic inflation hedge, that the market is a little concerned about a pickup in inflation, a reacceleration due to some of these Trump policies, right? Mm-hmm. And we're also seeing that if you go to the next chart on Treasury inflation protected securities, right? On these TIP ETFs, there's been a lot of inflows into them lately. And if you look at just the data series table here, that's just net inflows, right? So net inflows this year have started to turn positive, right? And if you look through the majority of the last couple quarters, they've been more or less negative. So you are seeing a lot of, I guess, participants in the market reach for a little bit of inflation protection in this. Yeah. And if you do, inflation is one of the most lagging economic indicators, right? We're always looking at things in the past. So if we try to build out a leading indicator on inflation, right, you could make a combination of metal prices, M1, and kind of the core service aspects of inflation, right? If you build out an indicator like that, you'll get a line chart that's been relatively, stalled. It's still at elevated levels, but relatively stalled, and it's starting to rise back up again, right? So this is almost a leading indicator to suggest that CPI is, more than likely going to pick up. It tends to bottom in expansions and top in recessions, right? And I do think the implications of these tariffs are really difficult to speculate on. But if they do go into full effect, right, that could easily bump core PCE up by 30, 40 basis points, right? And inflation could easily go above 3.5% again. But I don't think that these would be necessarily permanent issues, right? And I think the Fed's reaction function would be more to look through these price level impacts and kind of holds rates steady, as opposed to looking to do any type of hikes, right? Because if you go back to
also, I just want to counter that. Remember the last time they looked through transitory price rises and what it did to them? Do you think there's a PTSD element to that, and they may actually try to be a little bit more proactive than before because of how much of a mistake they made the last time they tried to see through?
I could see that to a sense, but again, I think that would be a mistake because we're looking at some very different economic backdrops, right? The last bout of inflation was really driven by a ton of fiscal.
Yep, understand.
Right, and this Trump administration seems like they want to rein that in, right? They want to control the deficit a little more, and I think this round of inflation that would be driven, let's say, by tariffs is very reminiscent of 2017, 2018, right? Where if you look at the tariff rate on Chinese exports, they rose from, I believe it was a little under 5% to over 20%. In turn, the impact that had on US GDP, which was sitting a little above 4% at the time, brought GDP back to under 1%. So I think tariffs ultimately could provide a slight boost to inflation, but that would be temporary. And I think tariffs essentially tend to lead to a contraction in disposable incomes and trade, which ultimately becomes deflationary.
Okay, understood. I want to again. We've been led around by services or sticky services inflation of late, and what people are starting to look at a bit more is the goods component, which has generally been on the soft side in terms of pricing. But as this chart shows, we have seen it. It's now stopped retreating, if you like, or stopped softening and starting to sort of level out. What do you see? What can you see from the core goods here that either worries you or gives you hope, or what?
I would say that there's two sides to this. It worries me a little bit because, like you said, a large source of disinflation has been in that core goods area. And I do think it has kind of bottomed, and we should continue to see a rise. And if you look at, seasonality in the month of January, we definitely get some upside risks to that core goods sector. However, I can take the opposite side of this and say a risk to this would be an improving supply backdrop, right? And this print here, you're going to get a little bit of distortion too, and used car prices are likely going to be much on the higher side here because of these wildfires in LA. So that's going to be a big driver of that, the core goods. If you look at core services, right, core services should tick up. The rental inflation is probably going to be little changed from December, but OER possibly is going to rise on this because each January, the BLS, they've been increasing the weight of single family detached homes within that basket of OER and decreasing the weight of multifamily homes. And this caused a spike in OER last January. So I think we could see that come in a little hotter, which is only going to kind of push this inflation metric a little higher. If you look also at alternative data sources, you're kind of showing flattish to marginally positive apparel prices. There's room for upside in lodging away from home. And I still think OER could even get a boost from some of these LA distortions.
Oh, yeah, okay. So the wildfires could still complicate or just muddy the waters a touch on all this.
And I think, on this print, the unrounded numbers are going to be very important, right? Because if we look at, core month over month, right, it's forecasted at 0.3, right? You take that unrounded, I think we're sitting, median's probably around 33 bips, right? So, if it misses 2 bips to the upside and comes in at 35, it's going to be rounded to 40. So the market's going to take that very differently. So I think you really need to look at the unrounded numbers here, right? And I think core at 33 bips is pretty right. That should help year over year tick down to 3.1. There's going to be some favorable base effects in there. Headline, probably 27 bips unrounded, has the potential to bring headline down to 2.8, right? But like you mentioned at the start of the show, we do get annual revisions, right? And there's a possibility that shows inflation a little higher in the past, but in this year it's decelerated a little quicker. But I still think these revisions are going to be pretty modest, and I don't think there's going to be a huge impact on that. I think the big question that everyone's going to be asking is, what's the Trump administration, right? The fiscal, the trade, the immigration, what impact is that policy going to have on inflation, right? And personally, like I said, I think it's going to be mildly inflationary, but I think that comes with some consequences. And I really don't think we're going to have a clear read on this until the second half of this year. And a reason for that too is seasonal adjustments from January to March are just a living nightmare to deal with, right? And these kind of roughly account for 50% of the total CPI from now since COVID. Is all in seasonal adjustments. So there's a lot of mixed forecasts out there. And honestly, I don't think anyone, including myself, really has a clue. We're just kind of giving our best guess here. And I think you're going to see a much cleaner inflation picture from April onwards.
Okay, and from the Fed's perspective, holding off from any moves in the near term will be justified by this factor that you're mentioning here, I guess.
100%. Yeah, and I mean, I think if you look at that again, if we go to that very last chart there before touching on rates positioning, you've kind of seen that in the front end of the SOFR curve, right? We've kind of gone from pricing almost 2 cuts at the start of this year to, now we're down to what, call it 35 bips. So we were at like 1.75 cuts of pricing to down to, 1.5 cuts right now. And this happened on payrolls. And I think if inflation comes in a little hotter today, you could see this move to where we're pretty much sitting there pricing in just 1 cut for the rest of this year.
Okay, fair enough. Trade by Carty, do you, I hear you. You want inflation. You see better trading environment with subdued inflation. But at some point, do you sit on your hands until we start getting cleaner prints in April, or how do you look at I guess the Fed policy at the moment? How much do you take into account Fed policy, and obviously I think a tighter monetary environment is something you're not happy. It wouldn't be your optimal trading. But where do you see Fed at the moment, and how you position yourself with the Fed?
Well, right now, at least in crypto trading, since the inception of Bitcoin, there's never really been a recession. So the market participants are pretty, in my opinion, uncertain on what would entail for the future or the trading environment for crypto should there be a tightening effect. But of course, you got to look at it. I mean, all traders are hoping for the Fed to inject liquidity into the market, at least on the crypto side. And crypto, if you look at it right now, or at least since since I got into it, at least almost 9 years ago, you always have like the traditional skeptics say, "Oh, there's no intrinsic value, no intrinsic value." So if that's the case, then it's really narrative driven and fundamentally uh, driven by macro factors. Um, right now, at least on the looming landscape, I see not too many fundamental factors that could really, I guess, say, push Bitcoin to a new all-time high.
Right.
And if you want to talk about, say, Ethereum as well, that's a whole different story in terms of the crypto landscape. That in itself, we could touch. It would be a bit more technical in terms of talking, but
if you
I
can
see
touch on
right.
it, if you can touch on it within
Yeah,
the next, just for me, someone who is still learning about all this,
right.
just explain a little bit on what you mean by that.
So Ethereum is considered the decentralized world computer, and people are supposed to build all these applications on top of it. When I first came in, it had this huge run up during the ICO craze. Sorry, ICO, yeah, ICO craze. And then in 2020 and 2021, it had its NFT craze, and now other coin called Solana has overtaken its narrative, say for this meme coin
Right.
phase where you could just create a coin within. I could have created a coin while we we're on this call and told you. I mean, I didn't do it, but I could have. That's how easy it is nowadays. But the problem with Ethereum, it doesn't really have a narrative right now, and I think the street is very uncertain how to quantify it and find its own intrinsic value. Whereas Bitcoin is Bitcoin. You just know what it is. If you want to call it internet money, fine. Ethereum, it's very hard to define what it is, and if you were to use crypto as opposed to just trading it, um, at certain points when there's a spike in Ethereum usage, it's relatively expensive to use, even though they said since this thing where they had a system upgrade called the merge, it was supposed to get deflationary as people use the network more, but people have been using it less. So now it's becoming inflationary again.
Right.
But so there was a problem once where Ethereum was kind of, like I said, the gas price. So people started building this thing called L2. So they make a blockchain on top of Ethereum, where they use the same code as Ethereum, but the fees are cheaper. And there are so many of them right now that it's just cannibalizing the use case for Ethereum. So no one's really using. I mean, some people are using the DeFi narrative and total value locked and doing the DeFi on Ethereum, but the main traders can't really decide what it's for. And I'd say right now, if you're just strictly crypto, now it might be a bit late, or I don't know if it's too late. I can't really tell you what to do, but longing Bitcoin, shorting Ethereum has been the best spread trade you could take. I don't know, in the last year and a half, you never lost money. You were never in trouble. So,
Okay.
with that being said, though, just back to your main point, uh, I think going forward here, everybody who's been in the markets for a while is always probably, if they haven't been in crypto, they've seen, wow, crazy running crypto, crazy running crypto. And yeah, these things are going to happen, but it's only with a risk on environment. You're not going to have, um, like as Sam was saying, the Nasdaq is underperforming on the year, so those are the riskier stocks and the tech stocks and stuff like that. So you're not going to have crypto outperform, say, to the downside. It's like the downside capture. It's like it's not something that you want to expect to outperform to the downside, because
No, understood.
yeah,
Different dynamics in
and
the
it's.
direction that it takes in terms of trying to trade it in
But
one
I will
phase
say,
to another.
yeah, but I will say though that because crypto is still pretty nascent, there are market inefficiencies that could be extrapolated um, very easily compared to what you would see in the traditional markets. I'm not going to tell you all of them. I mean, maybe I'll say one because I don't really trade them. But like, if you look at the crypto options market,
Right.
it's there is an efficiency there. But
Because
on
it's
the
so
other
new.
side,
Because
yeah, exactly.
yeah, people are just engineering now, like Scholes model, whatever it may be at the moment. So
Yeah.
yeah, I get it.
And then also, like, and the last thing I'll say is that the problem with, like, a lot of traditional guys will come into crypto and, they start looking at the way it works. If you just look at, I believe last week, there's a crazy wipeout um, across the board in crypto. I mean, Ethereum fell 40% in 3 days over the course of a weekend. Yeah, it was due to the tariffs, and it's the only thing that trades on the weekend. But, um, there's, like, I'll just explain. There's a thing on the margin exchanges called a mark price, where they find the price of the underlying asset through like a formula of a reference price between all other exchanges, and Coinbase is usually the biggest one in the basket. And what happened on that day is someone just pulled liquidity on the bid side on Coinbase, causing a cascading liquidation event. And it can be said that a lot of market makers blew up in the Ethereum option pool on Deribit because of that. So
Right.
um, so the market is still nascent. It's still a
It's,
low liquidity market compared to what's out there.
yeah.
But because with that, you could still consider an emerging market, and there are
Opportunities.
opportunities to generate more alpha than you would, say, just trading the ES straight up.
No, fair enough. It's good to know. Thank you. Right, I wanted to wrap it up now because we're less than 45 minutes before we actually get this inflation readout anyway, to give people time to prepare. Just a closing note then, Sam, from your perspective, 10-year note futures at the moment, we've been on a ride. We can say that of late, the start of the year. We've got, Trump isn't going to be quiet anytime soon. So you probably expect more of the same in terms of the volatility coming to the 10-year. Also, again, with Bessent now in charge, and also seems to be the adult in the room in terms of targeting 10-year yields. You see a bit more activity in this sector of the curve.
Yeah, I think, with the recent comments, there's going to be a lot of focus on that 10-year and obviously term premium. Rates positioning was obviously very stretched, with CTAs being extremely, extremely short. I just want to do a quick preface on this too. I mean, from a portfolio management standpoint, right? You're in a market right now where I think timeframes need to be a lot shorter, because you are getting so much headline risk and volatility seemingly increasing. Moves are larger, a little more liquid. You're facing a lot more, weekend gap risk on something. So I think you have to be hyper aware and really adjust your position sizing accordingly, on something that you might come in and risk 100 bips on. You may need to tone that down to, 35 bips of risk on something because of this volatility. So, we're kind of, from a portfolio standpoint, we're trying to shorten our horizons a little bit, and tone down position sizing, just to avoid any being caught on the wrong side of something here. But with that being said, since mid-January, you have seen, the market kind of adding duration in the belly of the curve, right? And this is kind of as the curve has flattened out some, right? We had a nice steepening coming in, and, over the past couple of weeks, we've seen, some curve flattening here. So positioning 10s for me is still, it's been a little crowded since those payroll revisions did drive some additions to the short side. if you look at kind of modeled CTA levels here, right? CTAs are going to be looking to add shorts below that, 1903 handle, and they're going to be looking to cut shorts, cover their shorts around that 1011 handle, right? So
Right.
I'm really focused here on, just a little bit of tactical trading in this 10-year aspect based on these CTA levels, right? Like just kind of riding some of their flows, especially if we get a catalyst that drives it. Like if inflation does come higher, you could see, CTAs definitely re-engaging heavier on the short side below that 109 handle, right? So if you just look at this this chart here, I think it sets up some really easy tactical trades along some of these inflation ports. You kind of want to get short into that 109 handle versus, stopping out above that, 1013 handle and kind of just watching that 109.26 is some sort of form of resistance there to possibly add into shorts and then kind of push it down a little harder as we cross those CTA sell triggers.
Okay, interesting, good stuff. Right, I need to wrap it up here now, but listen, I'd like to thank you both for your input today. I just hearing from traders, hearing from the guys at the coalface is always preferable to try to hear from some. Well, I love economists, but you know what I mean. People that actually are in it and trade it, it matters because you feel the pain, you feel the elation when you on both sides. So, thank you both for your input. I'll put up all the details so people know who you are afterwards. But thank you, Sam, of portfolio manager at 333 Capital and Arb Asset Management. Thank you to Trade Boy Carty. Do you want to mention who you trade through again? You said there was a particular group you're with?
Yeah, I'm with Credo V.
Credo V.
It's the crypto desk for RTG.
Awesome. So, and we'll post your social media tags out there again. But thank you very much for joining. Listen, to everyone else listening, thank you very much. Just to quickly recap, then we have CPI data out in about 40 minutes from now, just under 40 minutes from now. We're looking at a headline inflation rate year over year at 2.9. That would leave it unchanged from last. On the month, we're looking at a 0.3 from 0.4%. Rise last month. On the core reading, the ex-food and energy, 3.1, the dip from 3.2 on the year over year. Month over month, we're looking at 0.3 versus 0.2. Keep an eye on the unrounded numbers. We will focus on them as well when we read the numbers out. For anyone who doesn't know or hasn't tried LiveSquawk.com, go to LiveSquawk.com, take out a trial. You may just be in time if you go through the process. It's not that long. It doesn't take long. And listening to today's inflation report, which is at the bottom of the hour, and hopefully things from your trading day as these shows as well. Thanks, guys. I'm going to sign off now, and I'd love to have you two back on again. I think it's been really valuable.
All right, thanks so much, Harry. Yeah, happy to be back anytime. Good luck, everybody.
Cheers, guys.
Thank you so much.
Thank you. Bye.